This was a public-private partnership that only you could have assembled, and we are taking back our sovereignty, and we are going to have this Vault project, a strategic mineral reserve.
Welcome back to Real Estate Mindset. Silver demand explodes, Wall Street panics, and now we have Operation Vault. Not only are we going to talk about that today, we're also going to go over some price forecasts for silver by Mitch Vexler, who's going to go over the cone and standard deviation. We're also going to talk about the systemic failure and the overwhelming market manipulation, as well as going over a brief brand new article from Mitch Vexler. And we have a very, very amazing update on our advocacy efforts as the Texas Supreme Court has finally responded to Mitch Vexler's lawsuit, and we have a date for arguments. Either way, we hope you guys enjoy. Starting with this breaking news, Trump launches a $12 billion minerals stockpile to counter China. Critical metal shares jump 7.8%. U.S. rare earth shares rise 7.1%. Now, I think it's important to note here, though, that's only $12 billion. It doesn't necessarily have anything to do with gold or silver. Maybe a little bit silver, but again, this has probably nothing to do with actual silver and gold prices. This coming out from Silver Trade, physical silver demand at SD Bullion explodes to 2.5 times the previous all-time record. SD Bullion shatters silver sales records and aftermath of historic silver price smash. A lot of people purchased on Friday, you guys, a lot of people. Friday was unlike anything we've ever seen. The market panic and buying surge on January 30th produced the largest transactional day in SD Bullion history. And they are a massive bullion company, you guys. So when they hit a new record, we should pay attention to that. They're saying when paper silver collapses, physical buyers rush in. Also out from Silver Trade is the massive amount of withdrawals from CME Group. They're noting that COMEX Silver Delivery report, big silver withdrawals continue in COMEX Vault, and they're showing you guys all of the ounces that are allegedly, right, allegedly being withdrawn from COMEX. Not very much life left in COMEX. Now, obviously, everyone knows that we can trust JP Morgan to give us the truth, and we can trust them not to manipulate the metal markets, right? What do you guys think? But either way, this is what they're saying. Just in, JP Morgan expects gold prices to reach $6,300 an ounce by the end of 2026. Also, more flip-flopping from Wall Street, and it's not about crypto. Wall Street banks are saying, buy the dip in gold as the metal recovers Monday. Absolutely insane. These guys, absolutely insane. Also, some breaking news here. China plans to put dollar to an end with a massive gold and silver reserve aimed at making the yuan global reserve too. Now, the market just opened. Silver futures just opened, and it is up, as you guys can see here, about 4%, sitting at $80.22. Now, the settlement price, remember, you guys, the settlement price is different from the closing and opening. The settlement price today was $77 even, pretty much even. Now, Shanghai silver price closed at $104.79. So you may think like, oh, that's a lot lower, right? But look at the gap, you guys. The premium is absolutely insane. So the premium right now between Shanghai and the US for physical silver is $26.78. That is a massive gap. The physical market and paper market is absolutely diverged right now. The paper market is broken. Gold to silver ratio today at 58.12. Wanted to remind you guys, it's actually pretty much pushes us back to the beginning of January. We kind of had a crash, yes, from manipulation and all kinds of gimmickry. But look at this, guys. We're really just back to the beginning of January. And as I'm recording this video, the spot has gone up about, like I said, about 4%. But one thing I want to remind you guys is if you're going to play the physical metal game, you got to be super careful going into the market and going out of the market because they're passing on the volatility to consumers. And you can see that when you go to Bullion Exchange, when you look at what they're purchasing silver for, look at that premium. That $12 premium represents roughly a 17.1% premium to sell your metal. Raise your hand if you would do that. If you're a true stacker and you're holding for the long run, ain't no way you're going to pay 17% to sell your metal. You're just going to hold and wait for the market to balance out. And it's not just on selling, you guys. To purchase physical metal right now, you guys see the premium is about $7.69. That represents about 9.6% to purchase. So if you're going to buy and sell, say you freaked out, you sold, and you freaked out and you bought, you're going to pay to get in and out of silver right now a premium of 26.7%. So you got to choose wisely. And that's why Mitch and I always say, buy slow, hold long. Now, Mitch is going to give you guys an idea of the probabilities and movement of silver going to about February 14th. Mitch Vexler, thank you for the chart. Thank you for your time. What do you see happening over the next couple of weeks?
What we had discussed in the prior couple of videos was using these volatility cones to determine what would be a possible, probable, 1 standard deviation, which is green, 2 standard deviation, which is blue, 3 standard deviation, which is red. What are the probabilities of the price moving between the low and the high? Well, if we go out to February 14th, give or take, that's where we are. So the probability based on the current volatility, and I'll come back to that in a second, the probability of price would be $60.80. It's rough, doesn't matter, is an idea. The probability of the high would be 103. Well, with regard to the volatility, based on what happened today to where we are right now, if you recall, a couple days ago on Friday, silver was at 130, and the implied volatility, I believe, was at 86. Right now, it is 72 on the implied volatility and 103 on the implied volatility rank. Where could it be? Well, yeah, it could be at 60, and yes, it could be at 103 by February 14th. The issue at the moment, because everybody says, well, where's it going to go? Nobody knows for sure under any circumstance. However, recognize what happened. So today at the close, we had it gone as low as $70 today. And isn't it interesting that a prior swing low was at 69.337? That's where my cursor is right now. Reasonably close to a double bottom. Problem we face at the moment is that we have an inside bar forming right now. It can go sideways for 10 days. That's a possibility, which means it's going to come over into here and just stay in a range. Problem with the range is, given the size of the reversal bar, so this is your entry bar, and this bar here is massive. Well, in theory, when you have that pattern, it can come up, lo and behold, 10 days, 2 legs. So it's 10 days, 10 bars, 2 legs, sideways to up as a pullback, and then start going down. We won't know what the psychology of the market is until we get a bull bar that closes above this bar. And that means that this would be the low right here at 70. It closes above here at 87, and we have a true positive bull bar headed up here. That would mean that this is the reversal bar. So it's called your signal bar. And then your bull bar over here would be your entry bar. Why? Because your stop would go right here. So worst comes to worst. Now, bear in mind, this is silver. These contracts are huge, which is why they've extended the intraday margin because of the size of these bars. This is big money. Even on the micro silver, it's still big money. With that said, we need some activity to show where this is really headed. When I say headed, that means the psychology of the market.
And Mitch, I know the market just opened, but it looks like that's a bull bar forming right there, if I'm not mistaken. Is silver's up, what, over 6% right now? Is that
Yes.
what we're saying?
Yes, but it's still an inside bar, right? Because here's the high of the bar from today, which was 88,
Right.
and here's the low. We need a breakout above 88, or we need a bear bar somewhere in here that says it's going to go lower. At the moment, although yes, it's up, and yes, you could trade this. I wouldn't recommend it, but yeah, you could trade it on a 5-minute bar at the moment. Kind of foolish. You got to wait for the Asian market to open. But like I said, we need positive indication. And at the moment, there isn't any, regardless of what it's doing.
Let's jump right into the market manipulation, because there was a lot of things that were suspended. A lot of margin hikes are going to increase probably by the time you guys watch this video. I mean, they're attacking silver like crazy. This is saying, I just went and got the data myself. Yes, they are rating SLV. We'll get huge. Lots of Asians were just buying in our market to lock prices. That's a lot of liquidation, margin hikes, and narratives as well. The big arbitrage is likely happening now. Also, some breaking news, and this was a little bit earlier today, y'all. Shanghai Gold Exchange raises its margin requirement from 20 to 26. So you can see they don't like this, right? They're trying to slow it down. Effective after today, so after the close of February 2nd, COMEX also raises margins again from 6 to 8%, and then the highlighted risk for gold from 6.6 to 8.8, and silver even more from 11 to 15, and for the heightened risk 12.1 to 16.5. So they're increasing these margins pretty drastically. They also suspended the Shanghai futures. So a circuit breaker tripped the market. Unfortunately, why didn't that happen here again to see me? Look at Shanghai's doing it, right? They're doing it. Breaking, it appears the Shanghai Future Exchange has suspended or halted silver trading yet again. First time Friday, second time last night, and now this morning as COMEX bankers attempt to smash silver. What a time to be alive. This is interesting, and I'm not saying this. Oh, wait, this is from Travis. Interesting. The volume of silver is very low today, meaning nobody is selling in large quantities. These are bankers manipulating the price on low volume. Some inventory they have, dumping that small supply into all the bids to paint the tape and make everyone think there's a sell-off. Interesting. Also interesting is this, the silver crash was caused by massive paper shorting. And just to give you guys an idea of how massive that was, 1.8 billion ounces. And we're just talking about a couple hours, okay? We're traded, not the whole day, just a few hours, guys, okay? The annual mine production is 800 million ounces of silver. So again, naked shorts, right? They're doing things that they don't have, right? They can't possibly have that. Mathematically, it doesn't exist. More than double the global mine production was traded in just a few hours. Meanwhile, the physical market remains tight, with multiple dealers rationing silver through different mechanisms. Also out from China, this is insane. Metal traders lose at least $144 million as hat flees China. Silver miners have just begun. If you really think silver and the junior silver miners can spend 12 years accumulating, finally break out in July last year, rally for 6 months, and then suddenly roll into another 13-year bear market like 1980 or 2011, you need to take a step back and think logically, but those stocks did get blown out today. This is very interesting from OX Nobler. Tomorrow will be the worst day of 2026. Not today, tomorrow, like on Tuesday. The new macro data just came out and it's much worse than expected. Not for us because we've been watching the true math under the hood. CME is hiking in margins again for the second time in just 3 days. This has never happened before. This is not normal. This is panic. And here's what will happen next. Maintenance requirements are about to skyrocket. Look at these insanity levels. Gold, 30%, silver, 35%, platinum, 25%, palladium, 15%. That's not risk management. That's desperation. Don't let them sell you the volatility narrative. This is about keeping markets orderly. This looks like a major institution blowing up and the system racing to contain it before it spills into the clearing firms and the broader financial plumbing. This last little bit before going into Mitch's new article, Rick Rule, we're in a bull market, don't waste it. In the 1970s, the gold price fell 3 times by 30% or more. And then 1971 to 1995, gold increased 6 times in the amount from 35 to 200. In 1974, gold fell from 200 to 100. Everyone's shaken out. At $100, missed the move to 850 by 1980. They're saying you have to prepare yourself financially and psychologically for a 20 to 50% pullback. Is that true, guys? You have to prepare yourself from that. Does that make you emotional? Does that make you worry? Comment below, let me know. Obviously, the market is highly manipulated by hedging, derivatives, leverage, naked shorts, and all of that type of stuff. So Mitch made this new article, again, brought to you by our advocacy, that's going to try to help you guys understand additional ways to make money in this market. This is titled Unwinding a Hedge, Mitch Vexler, whenever you're ready, sir. And by the way, thank you. This will be linked in our description. We're probably also going to send it out on Substack. And if you didn't read yesterday's Substack, you guys got to read it. Absolutely incredible. Mitch, when you're ready, sir.
Just before I get into the article, I have 2 comments that are pretty important. For those who are scaling in to precious metals, the pullback on Friday was money from heaven. And it is money from heaven because you make your money on the buy. You're putting your precious metals away for the long term based on currency issues that are occurring. That is a fact. The currency issues are occurring. Proof of that is the simple fact that the Chinese government is saying, we want to be the world's global reserve. I don't buy that for 2 seconds. They may want it. The world probably doesn't. And the reason that the world probably doesn't is because the debt to GDP in China is roughly 300. Ours is roughly 128. That's the motive that I referred to the other day in the article that we're about to discuss right now. So unwinding a hedge in furtherance of the last article that I wrote called Precious Metal Manipulation, Market Manipulation, Your Manipulation, now posted at mockingbirdproperties.com/DCAD. I thought that a quick conversation about understanding hedges is in order. To start with, what we saw on Friday's precious metals meltdown, we showed on a video what could happen, and then using what was known at that time as the volatility and the volatility cones days before the Friday event ever occurred. Does that mean it was destined to happen? No, of course not. The volatility cones are based on what is the then known volatility, which creates the probability of a price range. Volatility can expand or contract. When I started these videos, I made the case on multiple videos at the very beginning with Travis that to understand probabilities in business, one must understand the volatility, as that is what allows for the probabilities to be quantified. And this also goes into the study of Monte Carlo analysis, which we use in the futures market analysis and which we use to think through problems during the construction process, physical construction of buildings on any real estate project. If a trader had a concern about possible market pullbacks, such as on Thursday before the pullback on Friday, that trader could have done one or a combination of several trades. That trader could have, by way of example, simply exited the position, which makes perfect sense because hedges are expensive. They could have exited the position trading options with a long bias. They could have used options to protect their position using an offsetting hedge. They could have bought puts to protect the profit. They could sell a call spread and use that money to buy a put. A trader who practices delta neutral portfolio trading could have exited the metals position with very little change to the delta neutral position. If in an options position, one could have utilized the futures and traded short. You hold the options, you use the futures, and you go short to offset the potential loss on the options position. This is a version of delta neutral trading on a short-term basis. The point that I'm getting at here is that options allow for flexibility. The point to the above shows why it is important to have the education in options trading and futures trading, both with the ability to read the chart bar by bar to understand the psychology of the current market, regardless of whatever time frame one is trading. With regard to unwinding a hedge, this involves closing out positions that were initially established to protect against potential losses. This can be done all at once or incrementally, depending on the investor strategy and market conditions. Unwinding a hedge involves closing out positions that were initially established to protect against potential losses in an investment. This process can be executed in different ways depending on the investor strategy and market conditions. There's different methods to unwind a hedge, one of which is just unwind it, complete removal, get out, you're done, move on to the next trade. You can do incremental removal alternatively, where the investor may choose to unwind the hedge gradually. The reasons you would look to unwind the position is what happened possibly on Friday. Market took a nosedive, you were short, you made your money, you get out. You might want to be rebalancing your portfolio. That's a reason to do the hedge. Considerations during the unwinding would be the liquidity risk. That's an interesting topic because margins went up as the day went on. That means your cost of doing these trades, if you were a mom and pop trader, skyrocketed intraday because the brokers didn't want to take the risk because the bars, the height of the bars, the volume of the bars got too large. Remember, silver is a massive contract. You're trading 5,000 ounces in every futures contract. That's how big this is. And one has to look at the cost benefit analysis during the unwinding. Unwinding a hedge is a strategic decision that requires careful consideration of market conditions and investment goals. I want to point out that at the tail end of Friday, the market started to pull back up. That is what the unwinding of hedges looks like. Investors can unwind a hedge effectively by using strategies such as gradually closing out positions to minimize the market impact, employing limit orders to control the execution prices, and monitoring market conditions to time the unwinding appropriately. Unwinding a hedge in a volatile market can lead to significant financial losses, especially if the market moves against the position after the hedge is removed. Additionally, it may result in increased costs or reduced value of a deal if the timing of the unwinding is not managed properly. This may have been what multiple people got clipped with on Friday for those people who actually had what were called junior minor stocks. They hedged intraday and then got whipsawed around on both sides of the equation because they weren't moving fast enough. Here's the most important point of this, and this is where this whole article was truly headed. The purest form of trading with the least friction, meaning the least cost, the fastest way in, the fastest way out, the least amount of noise, is based on the price action of the futures. That's number one. Trading a little bit longer term would involve the options. You can use both the futures and the options to trade around a position. But education is the key. If a person chose to study the price action of just one underlying, forget the noise, forget everything you hear in the press, such as a micro gold, that's a /future MGC, looking for a specific pattern which shows the market psychology, 10 bars, 2 legs, sideways to down as a pullback, then that person could do well trading small and trading within a 2-hour time frame early in the morning and go on with their daily activity. If you can make, just on the futures, just looking at gold, you're in the market for 2 hours, you're getting your education, you're getting your feet wet. Why do you care about anything else? You make $200, $500 in a 2-hour time frame, you're done. You don't have to give the money back. That's your time, that's your work. Your work. You set these time periods up. If that same person was a long-term holder in physical gold, that person would not have to trade to the long side. That person can simply say, I'm not trading long because I have the physical. I'm only going to take trades to the short side. That has the ramification of giving additional revenue for that precious metal sitting there. It's goosing the rate of return, and you're eliminating a vast majority of the risk because you're only trading to the short side. The point being, education, both on the options and the futures, is the key to understanding the article that I wrote yesterday and this article today. These two articles are tied at the hip and are exactly what had happened on Friday's meltdown, today's itty bitty pullback, and we'll see where it goes tomorrow and the next couple of days.
Now let's go into the systemic failures that are happening right now, just a little bit, and then we'll go into the response of the Texas Supreme Court. This is from Shibo. Financial lockdown is coming. There is talks of maximum pain coming for the monetary system. You must utilize the available information and position yourself accordingly. This isn't about getting ahead. This is about saving your family and friends. Brace yourself. So I would just point out, though, that they're missing just one thing. What's the solution here? What can we do to brace ourselves? Anything? Comment below. This is a good one. A massive amount of U.S. debt is coming due. $9.6 trillion. I'm going to say that again. $9.6 trillion of U.S. marketable government debt will mature over the next year. That's the most ever. This is double the number seen before the 2020 crisis. It's double, guys. This also accounts for 33% of all outstanding debt, one of the highest percentages in history. So the amount and the percentage high. Most of this debt must be refinanced at significantly higher interest rates compared to the 2020 crisis when the Fed funds rate was near 0%. The US debt crisis is hitting new levels. Another warning issued from Danny, a big storm is coming. No rage bait. Even last week's dump was just the beginning. This hasn't happened since 1968. Listen carefully. For the first time in 60 years, central banks hold, I'm just going to read this one thing, hold more gold than US treasuries. What can that tell us? Some more breaking news, a lot of breaking news today. The US dollar may, this is a maybe, in the fifth major bear market going back to at least 1967. You guys see that? It's down about 12%. Once we hit 30%, we're going to hit our fifth bear market for the dollar. So it's on its way, still a little bit further to go. Which brings us back to the final of this video. I'm going to take you guys to the update. A lot of you have been waiting for the update from the Texas Supreme Court. But before I get there, I also have an update. It's not just Mitch. I have a completed criminal complaint. Again, you guys, I want you to go to my website, realestatemindset.org, go to the fight tab, become a citizen journalist, please. Become a citizen journalist. I'm begging you practically. But I just finished our conflict of interest criminal complaint. I want you guys to take a look at that. The entire story is there. I'll probably put out a Substack. It took so much. And also, I have these resources linked. If you guys want to review 990s, nonprofits, political action committees, just click this. Go to these links and start investigating corruption. Here's my criminal complaint right there. Isn't that cute? It's a little bit Mickey Mouse. I'm not like Mitch yet, but I'm getting there. Look, I even put pictures there. Isn't that nice? I put pictures there because I'm assuming they're not going to look at everything. So I wanted them to look at some key pictures there. And also I wanted the public to be aware. And don't forget, you guys, when you're done with that, go to mockingbirdproperties.com. And then I want you to go to the motion for rehearing, which looks like this because we have an answer back finally. And I'm going to bring that up and I'm going to show you. The Supreme Court of Texas responds, you guys. And this is a beautiful, beautiful thing. Dear counsel, the Supreme Court of Texas orders a response, yes, to the motion for rehearing in the above referenced case. That is going to be due by February 17th. They are letting us play. Mitch, the entire country is behind you on this, man. Can you just highlight some of this response that you emailed me a little bit earlier today?
What we're doing here is not our response yet to opposing counsel. So opposing counsel will submit by February 17th their response to my request for a rehearing. So what I'm doing here, as we have done all the way through this process, is to keep everybody that's watching fully informed. And it's very important because even today, I received another email out of Colorado trying to get on board with what's happening to explain it to judges in Colorado. We have all the evidence that's on our website, so we're helping everybody that reaches out that is pushing forward on their own. But this case has more ramifications, not just in Texas, but across the United States. Opposing counsel's response is due February 17th to the Supreme Court of Texas concerning the constitutional issues defined in the motion for rehearing, which is available on my website, and Travis has the links in this document. This document will appear below the video. The Supreme Court has opened for review the constitutional issue brought forth, which outlines A, that there is no redress in the case of fraud committed against a property, residential, land, or commercial, and its owner by a taxing authority created under the appraisal review statute to show how the fraud has been created and manipulated from which a legitimate resolution may be obtained. B, the appraisal process disallows investigation of fraud in the process, which negates the very existence of uniform standards of professional appraisal practice. C, the statute, as unilaterally interpreted and exercised, prevents discovery of fraud. D, uniform and equal, a requirement under the Texas Constitution, is systematically ignored at both the Central Appraisal District and ARB hearings. There is no due process as unilaterally interpreted and exercised of structured review. F, the constitutional question: can the legislature or lower courts constitutionally bar judicial review of systemic fraud claims by confining them to an administrative scheme that lacks discovery, subpoena power, or fraud adjudication authority. G, why should the Supreme Court of Texas care? This is a classic open courts problem. If the ARBs are the exclusive forum, then property owners have no meaningful remedy for fraud. This is exactly the type of constitutional anomaly the Supreme Court of Texas exists to resolve. As I have stated in writing and on video many times, either the law exists or it doesn't. To be crystal clear, no constitutional entity can allow fraud to escape. The most important question for opposing counsel representing the Central Appraisal District, its employees, and counsel itself as an officer of the court, if you don't intend to allow the resolution of discovery by every Texan with regard to the property tax fraud being committed upon them, why is that? Everybody that's watching this video should go and read the motion for rehearing, the amicus brief to the Supreme Court of Texas, and the importance of the Vexler case to Texas. Those 3 links are going to be below this video. And those people that reach out to me constantly, I am referring these links to them because the history, the math, the case law, it's all there. And it's not just applicable in Texas. It's applicable across the United States.
We've been waiting for, it feels like, a year and a half for a response from the Texas Supreme Court.
Yeah, about, in reality, on the rehearing part, about 40 days. But this whole process with regard to the courts, we're coming on 2 years now.
Yeah, very good. And if you guys want to track us and follow along with us, because we could surely use your help, follow us. Go to the websites, not only with just abolishing property taxes, which is a huge deal. This is going to hopefully set the precedence for class action lawsuits and all kinds of other stuff, but also become a citizen journalist because citizens need to learn they have a voice. We need to take back our voice and we need to use it to call out debt, debauchery, fraud, and corruption. So go to my website, learn how to do that. Comment below. Let us know how you enjoyed this video. Let us know how we did. Share this video, like it, and if you guys can, hype the video. There's no feature on YouTube and it helps out a lot. Other than that, guys, I hope you guys have a great Monday. I hope you have a great week. And if you're out there just trying to live your life and figure out what's going on, you guys already know we wish you luck and we hope you win.